Welcome to StokTok's deep dive into Equinix. Equinix operates a global platform of data centers and interconnection facilities, serving cloud providers, enterprises, and network operators who need secure, carrier-neutral hubs to connect their infrastructure and applications. At the time of recording, Equinix was trading at $1,065.01 per share. The stock sits near the middle of its 52-week range, which spans from $710 to $1,128. The Relative Strength Index, or RSI, a momentum indicator that runs from 0 to 100, was at 57.6, indicating neutral positioning. The 50-day moving average stands at $996.55, while the 200-day moving average sits at $835.43, suggesting the price has been supported above its longer-term trend line. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Equinix owns and operates a global network of data centers across Asia, Europe, and North America. The company's competitive moat rests on geographic diversification, interconnection density, meaning the concentration of networks and cloud providers in each facility, and switching costs that make customers reluctant to relocate critical workloads. Revenue flows primarily from rental and interconnection services, with margins that improve as utilization increases. The company benefits from structural demand tailwinds in cloud computing and artificial intelligence infrastructure build-out. Our StokTok score for Equinix is 27 out of 100, which signals caution across valuation, financial health, profitability, growth, and smart money positioning. The score breaks down as follows. Valuation scores 0 out of 20, indicating the stock appears stretched relative to its fundamentals. Financial health scores 8 out of 20, suggesting modest balance sheet risk. Profitability scores 8 out of 20, reflecting returns on invested capital that lag historical data center peer averages. Growth scores 9 out of 20, pointing to single-digit revenue expansion. Smart money positioning scores 2 out of 20, a red flag we will examine in detail later. Now valuation. The question every investor has to answer: are you paying the right price? Equinix trades at a price-to-earnings ratio, or PE, of 79.17 times trailing 12 months earnings. This multiple is substantially elevated. To contextualize, the broader real estate investment trust, or REIT, sector has historically traded in the range of 15 to 25 times earnings. A PE of nearly 80 suggests the market has priced in significant future earnings growth, or is assigning a significant premium to the company's market position. The price-to-earnings-to-growth ratio, or PEG, stands at 8.1. The PEG ratio divides the PE by the expected earnings growth rate, and a figure above 2 generally signals elevated valuation risk. At 8.1, this suggests a disconnect between current valuation and near-term profit expansion. Forward price to earnings, which uses next 12 months estimated earnings rather than historical, is 65.26 times, still substantially above historical sector norms. Enterprise value to EBITDA, or EV to EBITDA, a measure of what investors pay for each dollar of operating cash generation, sits at 30.94 times. For comparison, most diversified REIT trade in the 10 to 15 times range. The price-to-sales ratio, or PS ratio, is 11.59 times, meaning the market values the company at roughly 11 times its annual revenue, another historically elevated reading for the sector. At the time of recording, GuruFocus Value, a proprietary valuation model, estimates intrinsic value at $887.83. The current price of $1,065 represents a premium of approximately 22.6% above this estimate, translating to a negative margin of safety. A margin of safety, in the view of value investors, is the discount between market price and estimated intrinsic value. When that number is negative, the stock commands a premium. Wall Street analysts, at the time of recording, have issued a consensus mean price target of $1,125, with targets ranging from $894 on the low end to $1,250 on the high end. 27 analysts cover the name with a consensus buy rating. The disconnect between the GuruFocus valuation and the street's consensus target underscores the market debate around Equinix's fair value. The next earnings report is due April 29, 2026, with the street expecting earnings per share of approximately $4.33. This near-term catalyst may provide clarity on whether current expectations are sustainable. Market sentiment around Equinix, as of the creation of this video, leans bullish, driven by tailwinds in artificial intelligence infrastructure and global cloud expansion. However, the valuation appears stretched relative to the historical rate average and relative to the company's demonstrated near-term growth trajectory. In our view, the setup for valuation does not look attractive at current levels. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist developed by accounting researcher Joseph Piotroski to assess the quality of a company's financial position. The score examines profitability, cash flow, leverage, and operating efficiency. Equinix scores 5 out of 9, indicating mixed financial health. Specifically, this suggests the company has passed some strength tests, likely around profitability and cash generation, but shows weakness in others, possibly around debt levels or asset quality. The Altman Z score is a bankruptcy risk model that combines 5 financial metrics to predict the likelihood of default within 2 years. Equinix's Z score of 2.70 places the company in the gray zone, the middle band between financial distress and safety. A Z-score above 2.99 is considered safe. Below 1.81 is considered distressed. The gray zone signals neither clear strength nor imminent danger, but rather elevated scrutiny warranted. Now let's examine the debt picture. The cash-to-debt ratio, which measures how much liquid cash the company holds relative to total debt obligations, stands at 0.14. This means Equinix holds 14 cents in cash for every dollar of debt. In absolute terms, this is a thin liquidity buffer. For capital-intensive businesses like data centers, which require ongoing maintenance and expansion spending, this level of cash coverage is modest. Interest coverage, which measures operating earnings divided by interest expense, is 3.73 times. This means the company generates $3.73 of operating profit for every dollar of interest it owes. While above the danger threshold of 2 times, this leaves limited margin for error if operating performance deteriorates. The current ratio, which divides current assets by current liabilities to measure short-term liquidity, is 1.32. A ratio above 1.5 is generally viewed as healthy. 1.32 is tight. Debt to equity, which measures how much debt the company carries relative to shareholder equity, is 1.61. This indicates the company is financed with roughly $1.61 of debt for every dollar of equity, a moderately leveraged capital structure for a capital-intensive rate. Taken together, the balance sheet shows moderate leverage with unspectacular liquidity. The company is solvent and generating operating profit to service debt, but the financial foundation does not offer substantial cushion in a downturn. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, measures how much profit the company generates per dollar of capital deployed in the business. Equinix's return on invested capital of 5.14% is concerning for a mature, capital-intensive business. Historically, data center rates that command premium valuations demonstrate return on invested capital in the 8 to 12% range. A 5.14% return suggests that either asset productivity is lagging or capital is not being deployed efficiently. This underwhelming return on capital is a fundamental problem when paired with the stretched valuation multiples we observed earlier. Gross margin, the percentage of revenue remaining after direct operating costs, is 51.09%. This reflects the nature of the business. Data centers have substantial real estate, power, and cooling costs built into the cost of revenue, but significant gross margin remains to cover overhead and capital investment. Operating margin, which measures earnings as a percentage of revenue before interest and taxes, stands at 21.33%. This is respectable and shows the company can convert a meaningful share of each revenue dollar into operating profit. Net margin, the bottom line profit margin after all expenses including interest and taxes, is 14.65%. This means the company retains roughly 14.7 cents of profit for every dollar of revenue, which is healthy, though interest costs consume a meaningful portion of operating profit between the operating and net line. Free cash flow margin, a metric that shows cash available after capital expenditures relative to revenue, is negative 4.34%. This is a material red flag. Negative free cash flow margin means the company is spending more in capital expenditures than it generates in operating cash flow relative to revenue. For mature business, this suggests either that capital spending is unsustainably high or that operating cash generation is constrained. This metric raises questions about dividend sustainability and growth funding. The profitability picture shows a business that is profitable on a reported net basis, but the efficiency of capital deployment is weak. ROIC of 5% combined with negative free cash flow margin suggests the market may be overpaying for earnings that are, in our view, of mediocre quality from a cash generation standpoint. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years averaged 8.3% annually. This represents solid growth, particularly in a mature infrastructure business. However, growth over the 5-year period averaged 7% per year, suggesting that the growth rate has been relatively stable rather than accelerating. In absolute terms, single-digit to low single-digit growth is respectable for a capital-intensive rate, but it does not justify a PE multiple of 79 times, which typically implies much faster earnings expansion. Book value, a measure of shareholder equity per share, has grown at 5.1% over the trailing 3 years. This is lower than revenue growth, signaling that earnings per share growth has been driven more by leverage and share buybacks than by underlying operational expansion. Dividend yield stands at 1.77%, which is modest for a REIT. Historically, REIT yields have ranged from 3 to 5% depending on the cycle and the specific company. A dividend yield below 2% suggests the company is prioritizing reinvestment or maintaining balance sheet strength rather than returning cash aggressively to shareholders. Taken together, the growth profile reflects a mature, moderately expanding business. Revenue is growing at mid-single digits, but capital returns and per-share metrics are decelerating. The market is pricing in much faster earnings per share expansion to justify current multiples, and the data suggests that expansion has not yet materialized. For a stock trading at a 79 times PE ratio, growth expectations should be substantially higher than what the historical data and current guidance demonstrate. This is a key mismatch between price and fundamentals in our assessment. Now let's talk smart money, what institutional capital is actually doing with this name. 9 top-tier investment gurus and super investors currently hold Equinix according to Dataroma, a database of concentrated holdings. However, the action among this elite group is concerning. Christopher Davis of Davis Advisors holds the stock but has reduced his position by 4.72%. First Eagle Investment Management, another respected value-oriented firm, holds a position and has reduced it by 17.72%. These reductions by respected value investors suggest skepticism about current valuations or conviction that capital can be better deployed elsewhere. Insider ownership stands at 0.66%, an extremely low level. When company management owns very little of the business, it reduces alignment with shareholders and may suggest management has limited conviction in future appreciation. Insider transactions over the last 3 months show 0 buys and 26 sells. This is a dramatic bearish signal. Insiders are consistently selling, which often precedes weakness as management has superior information about business conditions and future prospects. Among the broader institutional universe, 6.2% of 13F institutional filers, firms required to report their stock holdings quarterly, are net buyers of Equinix. The benchmark for this metric is typically 50%. Anything below it indicates net institutional indifference or selling. A figure of 6.2% means that of all institutional investors who file, less than 1 in 20 is accumulating the stock on balance. The combination of guru position reductions, minimal insider ownership, and heavy insider selling is a major red flag. Smart money appears to be positioning defensively or exiting, not accumulating. This positioning mismatch with the bullish Wall Street consensus and bullish news sentiment is striking and warrants careful consideration. And finally, the verdict. Let's bring it all together. On valuation, Equinix trades at a premium to historical sector norms and a disconnect from near-term demonstrated growth. A PE of 79 times, a PEG ratio of 8.1, and a negative margin of safety relative to GuruFocus Value all signal stretched pricing. We view this valuation as a significant headwind. On financial strength, the balance sheet shows moderate leverage, tight liquidity, and a gray zone Altman Z score. The company is solvent and can service debt, but does not offer substantial margin for error in a downturn. This is a constraint, not a clear strength. On profitability, the company is profitable on a reported basis, but efficiency is weak. And return on invested capital of 5.14% is substantially below historical peer benchmarks, and negative free cash flow margin raises questions about the quality of reported earnings. We view this as a weakness. On growth, single-digit to low single-digit revenue expansion does not justify a PE multiple of 79 times. Growth expectations are misaligned with current valuation in our view. On smart money, insider selling, guru position reductions, and minimal institutional accumulation suggest experienced investors are not rushing to own the stock at current prices. This positioning is a meaningful red flag that contradicts Wall Street consensus. Across all 5 dimensions, we see a stock that is stretched on valuation, moderate on financial strength, weak on capital efficiency, pedestrian on growth, and potentially being sold by sophisticated investors. The thesis for near-term upside appears weak, while downside risk warrants caution. We do not find this an attractive risk-reward setup at the time of recording. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Equinix. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.